Options Basics. I'll be covering everything you need to know, or the basic concepts about options. So first of all, basic concepts are required to better understand options and things that you need to know before moving on to more advanced strategies such as condors, spreads, J-lizards. Then I'll be covering option types, the terminology or the lingo that's kind of associated with options trading, directional positioning, the anatomy of position and option types, and lastly, things to keep in mind or important factors to understand and to take into account when trading options. So before we look at option types, there's two different styles of options. You have the European style option and the American style option. Now the major difference between the two styles is that the European option can only be exercised on the expiry date, and the American option can be exercised at any time until expiry date. So that's the major difference. If you look at minor differences, I mean both styles of option have different valuation methods, and there's a few other differences between the two styles of options. Now for option types, which is what's actually important, is that you have two different types of options, calls and puts. A call option gives the holder of the option the right to buy 100 shares of stock at a fixed price until a certain date. So when you buy a call option, it's always 100 for 100 shares of stock, and it gives you the right to buy. So it gives you don't have to buy it. You could let it expire worthless, or if it's in your advantage, you could buy 100 shares of stock and exercise the option. That's the advantage with option, is that you have the choice, you have the option to either buy or just let the option expire worthless. For puts, a put option gives the holder of the option the right to sell 100 shares of stock at a fixed price until a certain date. So it's very similar to the call option. The only difference is that instead of having the right to buy, you have the right to sell 100 shares of stock. So terminology. There are four important things you need to know about option contracts. All of those things that you see on the screen are all listed or written on a contract. So the strike price is the fixed price at which an option contract holder can buy or sell 100 shares of stock. The underlying is the stock from which the option is derived. So basically, if you have an option is in Apple, the underlying is obviously it's Apple. Then you have the premium, which is the price paid for the option contract, or the price paid for having the rights to execute or exercise the option. It is paid initially and non-refundable. So if you're buying an option, you have to pay premium, and if you're selling an option or writing an option, you receive premium. Then lastly is the expiration, which is the date until which the option can be executed or exercised. Depending on if you're long or short, either a call or a put, there are different directional positions that are reflected by the selection of either you're buying or selling options, and whether the option you're either buying or selling is a call or a put. So I like to really kind of to compare this to basic math. So when you're learning how to multiply different numbers, if you're multiplying a positive number with another positive number, the outcome or the product is going to be positive. So first of all, a call is basically positive and a put is negative, because when you're buying a call, you want the market price to be moving or rising in value, and when you have a put option, you want to the market price to kind of drop in value. When you're long, you want a rise in value, and when you're short, you're looking for really a drop in value as well. So if you're going long a call, the outcome is going to be bullish. So if you're buying a call, you want the market price of the underlying, the market price of the stock to go up in value so that you can profit. If you're long a put, so if you're buying a put option, you want the stock to go down in value. You want the underlying to drop in value. So when you're multiplying a positive number, going back to my basic math example, when you're multiplying a positive number with a negative number, the outcome or the product is always negative. Now going to the short side of things, when you're short an option, it's called riding an option, selling an option, whatever. A lot of people call it riding an option. When you're short a call, okay, so you're selling a call, the outcome of you want the market value, the share price of the stock or the underlying to drop in value. So you're multiplying a negative number by a positive number, outcome is negative. When you're short a put option, you're writing a put option, you want the market value of the underlying, you want the value of the stock to go up in price, to go up in value in order to profit.